we are ahead of the schedule, and then Steve and Michael have said a lot of the things I would like to say. So that would mean that I have a chance to talk about other things that are close to my heart, but close to this subject. The first is that actually this question about how money is created, it's all happened very recently. This change in mind from central bankers. In 2012. Perhaps some of you were along at that seminar we organized on sustainable finance here in Sweden. I was the key organizer of it. We had Lord Turner, who was a very good guy at explaining these things in a very simple way, talking about how money really is created and the issues around the monetary system. And actually, without mentioning any name, after the conference, a professor in economics came to me and said, "Ulf, is this really true? Aren't banks intermediaries?" And then there are some people from Riksbanken here, isn't there? Well, they actually asked us to come to Riksbanken and explain this money creation process at another occasion, because they felt that there were so many people in the Riksbank who didn't understand it. And this was 2012. It's only 7 years ago. Do you hear me? It works? Yes. Yeah. I mean, so Michael and Stephen have done a great job in trying to explain to people, and now they're getting it, I think. So I think it's actually more or less accepted by central bankers around the world that this is the way money is created. And without that understanding, we won't be able to move forward. But there is also another issue here, and that is, what is money? In this, what you are saying is basically that money is credit. This was not the old theorem; that was money commodity or well, a lot of other things. But now people understand money is credit. So this means that on one side of the balance sheet in the banks, you create the money, and the other side you create the credit, and that's the same thing. They are totally interrelated. Now, there is a guy called Charles Goodhart that is working he's over the 80-year-old, but still very active, and we work together at London School of Economics. He created a Goodhart's Law some 30 years ago or something like that. And all people who are reading financial economics are reading about this law. And what he basically said that it's almost useless to try to stop the creation of money, because they always find a way around it, the banks. And then he was thinking about moneyness, if I put it that way. There are a lot of things that actually are liquid like money and can be made liquid like money. So he said that there's a lot of money around that central banks don't have control of, or can look like money from the perspective of the users. And this is, in my view, an issue that I think we should think about a little bit today, because now in this new digital world, we are seeing a lot of private creation of money that is of another type than we just that Steve and Michael was talking about right now. We can see them even creating their own currencies. And what will that mean? What will that mean for money creation if people can create their own? Well, Bitcoin is not a. I mean, we have this is happening, and even banks are now getting involved in this process of creating their own currencies. So not only guys out there in the edge, the Bitcoin type of guys. I think there are 100 something digital or more. 2,000. 2,000?
2,000, yes.
1,000, okay. Well, it's even worse. So how will that affect how money is created? I mean, this is to me, I am very sympathetic to this thinking that maybe we should re-nationalize, because after what happened the last time, central bankers and finance ministers really didn't do what it would take to get the financial system under control. So that makes a lot of us who are into this thinking, maybe we have to give this up. Maybe we just have to renationalize. But can we do it anymore? I mean, the question has to be, we have to ask ourselves, what does it mean? Can we stop all this digital development and really renationalize the creation of money or not? I just want to put the question on the table. I hadn't in my speech, but I got these extra minutes. I think it for me, it's something I worry about. Now, let's go back to what I was planning to say. In 2010, just after the great financial crisis, Sir Mervyn King, who was then the governor of the Bank of England, made a harsh assessment of our financial system, and I would like to quote him. Of all the many ways of organizing banking, the worst is the one we have today. Change is, I believe, inevitable. The question is only whether we can think our way through to a better outcome before the next generation is damaged by a future and bigger crisis. That's the end of quote. That's quite a harsh assessment of a central banker who's not known to be a neo-Keynesian or anything like that. Many of people who have been central bankers have this position. Are really worried, and they have created a systemic council at Harvard where they are meeting and discussing and trying to make people realize that much more has to be done if we are going to get the system under control. And I mean, it's already been mentioned, but I just want to highlight it. The thing is that we really don't know what creates a financial crisis. There are many researchers that have tried to find that these things trigger. At post, you can see that it was that and that and that, but ex ante, it's almost impossible to really say this is what's going to happen. But what we know right now is that the global level of credit has never been higher and has surpassed 300% of global GDP. And that is about 3 times as much as we know that is needed for the real economy running. There have been some calculation, 120% of GDP, that is what you really need for the real economy running. 300%, come on. And this is also shown in the figures about how money are circulated in the world. According to the Bank of International Settlement, only 2% of all the international transactions are related to the real economy. Only 2%, which is telling you a real story. And then we have this question about the household debts. And I agree with Steve. I mean, actually, your figures were not really consistent. You had several curves about Sweden, but it doesn't matter. We can go through that. But what you showed at the end about the house prices and the house prices and the sorry. Oh, there you are. There you are. I was trying to look, where are you? Okay. But I mean, what we were showing at the end, that where the house prices and the credit was going in the same way, that's a real worry. I mean, we have for years have now an increase in credit that's as far above GDP. And this cannot be sustainable. I just read a report from one of the mega banks. I shouldn't say which one because it was confidential, but they were saying, okay, we shouldn't worry so much about these house bubbles because there will obviously be house bubbles and bank crises in Sweden, Canada, Australia, and perhaps Denmark. But these are small economies, and the bank crashes in those countries will not affect the rest of us. But they just took it for granted that Sweden will be in a financial crisis within a couple of years. And this is, I think, how people look at Sweden from the outside. This is unsustainable. And it most likely is unsustainable. The thing is whether a crisis of this type will affect the rest of the world. And then we have to look at these overall figures again. 300% of GDP. Okay, and then we have $3 trillion in junk bonds around. these junk bonds are related to ghost cities in China, steelworks in Russia, adventurous enterprises in Brazil, and to things in Turkey and Mexico, emerging economies. And the value of these junk bonds is very questionable. Just start looking at Turkey. Turkey is in a very dire shape. I mean, the economy there is so in such a bad shape. And they have issued a lot of bonds that are stuffed in German banks and other European banks. And right now, this weak economy is pressed by a trade war that our friend Trump has initiated. I mean, it's a scenario that's quite possible that this trade war actually will lead to a Turkish default. And if Turkey default, what effect will that have on European banks that are heavy stuffed with papers related to Turkey? And what effect would that have on this junk bond market? This is the kind of things that can trigger a global financial crisis. The thing is, we don't know. But it's possible to make a number of scenarios of this type. And we really have to be aware of how risky things are right now. We have, as Keynes expressed it 1920, 1930, we have a casino economy. Because the money creation is basically for speculative purposes, driving up asset prices all around the world to unsustainable levels. And this has to stop somehow. And one way of stopping it is, of course, through a financial crisis. But that is not what we really want, is it? So I promised to say something about, is there an alternative? So there should be a devil's advocate at this meeting. Could we do anything about the existing system without re-nationalizing money? And I would make some proposal. The first proposal that demands some elaboration is to halt the right for investment bankers to create money for speculative purposes. I mean, I'm not the only one to claim that it was a major mistake to allow investment partnerships with personal responsibility to be changed into investment banks without that kind of responsibility. And to reverse that decision would, of course, change the global scene dramatically, and especially because the 27 mega banks that dominate the global markets all have investment banking as their main business. You may remember that it was a failure of such a bank, Lehman Brothers, that triggered the great financial crisis. But you may not know that researchers at the Swiss University has shown that the mega banks now are so intertwined that all fail if one of them fail. And not only that, they are the cornerstones of a global conglomerate of 147 transnational companies that manage 40% of all global trade. And this is the perhaps most shocking finding of these Swiss researchers. They to 75% control one another. So we have a conglomerate of 147 transnational companies controlling 40% of global trade, involving the 27 mega banks that to 75% control one another. And of course, they have an enormous power. They finance both Democrats and Republicans in the US. They finance the Tory party, and more subtly, they employ European prime ministers and finance ministers when they leave their jobs and give them high salaries for being senior advisors. I mean, the president of the European Commission was so keen on this money that he couldn't wait a decent time before he left his job to become a senior advisor to one of the mega banks. And of course, these mega banks that are too big to fail are really protected by the system, because they know that if they fail, there is no alternative for the states but to go in and save them. And there has been a study of the $1.2 trillion USD dollar emergency loan program to global institutions that was part of the Federal Reserve rescuing scheme. And it all went to 22 of these actors. That's where $1.2 trillion American taxpayers' money went. So taking away the right for really, in practice, the right for creating money for investment bank purposes by making them into partnerships would be a major thing. The second is, of course, to increase the capital requirements from today's 12-13% to 25%, which is what Lord Turner and many others have proposed. And the third proposal is to re-engage states more into the process and realize that aggregate demand in the economy and credit volumes in the economy are also very linked to incentives created by the state, tax incentives especially. One of the reasons why we have this increase of debts in Sweden is that you have tax incentives for households to borrow, and you have tax incentives for companies to replace equity with loans. So it's really you have to re-engage the states. And the fourth proposal is to encourage the recreation of purpose banks and local banks, which actually are much more related to the real economy than these mega banks and international banks, universal banks that are here today. I could offer a lot of other actions to improve this system, but I will stop there. And the problem is, as many of you realize, that the alternative route that I indicate, I'm actually less than 5 minutes late. Okay, I had only one lane left, but if you want me, I can continue the 4. Anyway, the thing is that the solutions that I propose are almost as difficult, of course, to get political support for than the ones, the more drastic one, to renationalize money. The banks will oppose it, and they are very powerful. And as I obviously have a couple of more minutes, I will mention research done in Oxford by Nangari Woods and Walter Matley about what it takes to get regulations in the common interest. And that's a very depressing research, because they show that to get that the global regulation, especially not even national regulation, in the common interest, you have to have a sustained demand, forces that balance the power of the lobbyists and those helping to finance the political system. And this is, they looked at in the financial crisis and found that when Occupy Wall Street lost steam, when, well, if I may say so, even Positive Money lost a little bit of its steam, then the bankers took over and influenced the committees in the Senate and the Congress and made the proposal much less demanding for them than it could have been. So it's really an issue. If anything is going to happen, either my more limited proposals that I think we really ought to do, or something more radical, we really need a sustained pressure on the system that balances the influence of the actors, especially in the conglomerate, that will oppose anything. Thank you very much.